Hey everyone, thank you for joining us and welcome to Veg Food Fest, brought to you by the Toronto Vegetarian Association, otherwise known as the TVA. Thank you for selecting the on-demand programming over this amazing weekend. My name is Nital Jethalal. I'm the Vice President of the TVA. I also have a Bachelor of Commerce and a Master's in Science and Economics from Queen's University. My current focus is on plant-based economics and policy, and you can catch a quick talk that I have on that elsewhere. Today, though, I will be moderating a discussion between the three panelists you see in front of you on ethical investment, what to consider. Before getting to this amazing panel, though, a quick note to say that we hope that you enjoy the programming and will consider supporting the TVA as a donor or a member. As a member, you will get the Veg discount card, seen here, which will give you discounts from 5 to 20% at select restaurants and other businesses in the GTA. You'll get our quarterly newsletter, Lifelines, and become a part of the amazing community. And this month, for just $10, you can sign on to be a new member, or for $15 if you're renewing, courtesy of Mayan Sakar. Click on the link below to get started. And of course, please stay on the platform and enjoy more programming, the vendor lineup, and the entertainment. Now, to our panelists for today. Kelly McNamara. Kelly is the Director of Research and Writing at Pivot Food, a nonprofit dedicated to initiating large-scale divestment from factory farming and supporting investment in revolutionary plant-based, cultivated, and fermented food technologies. An entrepreneur and longtime business writer and researcher whose clients have included Harvard Business School and Ernst & Young, Kelly is now leveraging her skills and experience to help investors and business leaders accelerate the transformation of the global food system. A graduate of the University of Pennsylvania, Kelly studied at the London School of Economics and holds an MPhil in philosophy from Cambridge University. Welcome, Kelly.
Thanks so much for having me.
Sucheta Rajagopal. Sucheta has been involved in socially responsible investing, SRI, for over 20 years, advising clients on how to integrate environmental, social, and corporate governance issues into their investment portfolios. A portfolio manager and certified financial planner at Mackey Research Capital Corp., Sucheta manages one of the largest exclusively SRI books of business in Canada. Using plain English and a practical approach, Sucheta helps clients align their investments with their values. A trailblazer in Canadian SRI, Sucheta is excited to be helping build capacity in community and impact investing. She's currently a member of the advisory board of Marigold Capital, a Toronto-based investment firm focused on impact investing and gender lens investing strategies. She's a past president of the board of the Responsible Investment Association and has also served on the boards of East End Community Health Center, Straight Goods, and Planet in Focus. Sucheta has an LLB from Osgoode Hall Law School, and she is a graduate of the Canadian Securities Institute's Professional Financial Planning Program, a certified investment manager, CIM, a fellow of the Canadian Securities Institute, FCSI, and a certified financial planner. Sucheta has also earned Canada's Responsible Investment Advisor certification. Welcome, Sucheta. And finally, we have Claire Smith. Claire is the founder of the humane investment platform, Beyond Investing. She's a vegan environmentalist with 34 years experience in finance and investment at top-tier banks and investment houses, including UBS and Alborn Partners. Beyond Investing creates investment programs designed for animal advocates and climate-conscious investors in both public-listed equity markets and venture capital. Beyond Investing is the architect of the U.S. Vegan Climate Index, a stock index which screens out all animal exploitation and fossil fuel from a U.S. market benchmark, and the sponsor of the U.S. Vegan Climate Exchange Traded Fund, otherwise known as the ETF. Beyond Investing affiliate Beyond Impact focuses on early stage and growth companies that provide vegan, plant-based, and cruelty-free products and services. Based in Switzerland, Claire is the founder of Beyond Cruelty Foundation, formed to campaign for zero animal exploitation and to fund safe havens for animals, which will also receive a portion of profits of companies under the Beyond Investing umbrella. Together with IT strategist Danesh Kothar, Claire co-founded the Beyond Animal Integrated Digital Platform, which aims to accelerate the growth of the global vegan economy. Welcome, Claire.
Hello, it's lovely to be here.
It's nice to have you all with us. So we'll just jump right in. First question I have for you all is around terminology, because there is a lot of terminology in this area. Broadly, how would you define ethical investing, and what terms should people be familiar with in this area, such as SRIs and ESGs? Sucheta, perhaps we can start with you on that one.
Yes, definitely. I think what we're seeing now, especially if you're reading the mainstream media, is the most common use is ESG investing, which is environmental, social, and corporate governance, ESG, small c, capital G. And what that means is that an investment manager is looking at metrics relating to those three areas when they are choosing their investments. But there's, I think it's a little bit agnostic, because when you look at those metrics, you can give them any sort of weighting you want, which can range from very minimal weighting to very hefty weightings. So when you go back in time and you look at socially responsible investing, SRI, which is what I focus on, there's a little bit more of a moral weighting where you're saying, these are things we want. We'd like to invest in these things in order to build a better world. And these are things that we are going to exclude. So there is what's called a negative screening aspect to socially responsible investing, where there are typically exclusions around tobacco, military, nuclear, and certainly other ethical issues like factory farming, humane treatment of animals, worldwide slavery. So I think it's important for people to realize that right now there's a lot of terminology, and some of it is very general. So if you see a term like sustainable, it could mean anything. So it's important to dig a little bit deeper and see what that product or that fund manager is doing, what they mean by sustainable or responsible.
Great, thanks. Claire, Kelly?
If I could jump in, I think with the SRI, that really grew out of the specific requirements of a number of types of institutions, primarily, I would say maybe 20 years ago, to be avoiding certain types of companies. And this is where the negative screening started. I'm thinking particularly of religious institutions that maybe had some very specific requirements around gambling or I mean, I'm trying to think of a stock that's involved in pornography, but alcohol, all sorts of things like that. And of course, there's actually quite a big group of strategies which have been developed around the whole kind of Sharia, conditions around banking and interest payments, etc. So it kind of started from that, but of course, it's that is only excluding certain types of companies. And the ESG to me seems as if it is looking more broadly. Maybe sometimes it's a combination of the screening and then a combination of scoring. But on ESG, you can then score companies on all types of grounds and then kind of develop a portfolio around that scoring. So I think the ESG has the potential to be a broader application than the SRI, which seems to be about individual screening. And obviously you can combine the two. So you can decide, okay, there are these things we definitely will screen out, and we won't have anything in those particular sectors or those particular business activities. And then maybe combine that with ESG, which is using scoring, to then say, and of what's left, what will we tend to overweight or underweight, or will we remove things that are particularly high on some measures, but not remove everything. And I think things like carbon metrics, so environmental metrics, really lend themselves. Some of the social metrics, governance metrics like women on the board, is there a separate chairman? So some of those types of metrics really lend themselves very well to the ESG, and they wouldn't really work with the SRI, if that's making sense. So I think that's been part of the evolution, realizing that SRI was only going so far and it wasn't looking across the whole market and providing any kind of criteria to take into consideration that you could look at a stock and try and sort of position it or rank it on a combination of criteria.
Yeah, and to build on what you just said, Claire, for your viewers, you may want to look at the Farm Animal Investment Risk and Return think tank. They work on ESG metrics specifically focused on factory farming. And I think this began about 2016, at which point they said that ESG investors broadly are looking at fossil fuels, climate change, but few have focused on animal agriculture and its various environmental impacts, but also its social and governance risk. And FAIR, as it's called, has done a great job of setting up a framework that's by the ESG, within the ESG framework, and really mapping out what these risks involve, how they score companies against them. So I think that, again, for your viewers who are looking at learning more about ESG risks, specifically in animal agriculture space, that's a great resource. And I also wanted to call out differentiating between ESG investing and impact investing. So whereas ESG, SRI, this may focus mostly on exclusion, though there are some impact investment opportunities in the vegan space now. Impact investing involves more venture capital, seed funding, angel funding, investing in disruptive technologies, products, and services that you believe are going to help transform an industry in a way that you want to see it transformed. So just want to throw that extra bit of terminology in there.
That's helpful. I think a lot of people stopping by, even myself, I'm supposed to have some kind of background in this area, but it helps to have these things clarified because that confusion is common. All right, great, thank you. So the second question I have for you guys is around expectations. So how should investors calibrate return expectations in the realm of ethical investing? Should they be expecting to generate a lower return on their capital because they're including an additional constraint in the investment process that other investors don't have? Claire, you're smiling, so we can start with you.
I really hate this assumption or criticism around ethical investing, which I think, was much more current, let's say 10 years ago than it is now. The data that there is out there actually shows that applying these kind of criteria or some kind of ethical screening or scoring onto portfolios and then using those criteria to select the stocks has actually been pretty successful. I mean, it's happened quite a bit in the long only space, but I also used to work as a hedge fund analyst, and I even saw hedge funds who are kind of perceived to be, amongst the most kind of least ethical of investors, and the most kind of hard-nosed about, is this going to work or not, actually bringing these kind of criteria into their programs as well, because they had looked at the data and they had seen that the performance was there, that good governance did tend to lead to better performance of the company overall, which translated through to the profits and to obviously the returns of the company, including more women on the board. There's data around that. And in terms of the environmental metrics also, you could take the environmental metrics of a company and just say, is this a representative of, let's say, their efficiency in using resources? Obviously, from the standpoint of what I've developed, there are certain things that we in our program believe we shouldn't be using as resources. We're avoiding fossil fuel completely. We're avoiding animal exploitation completely because we don't see those as being resources that should be being used. But what we've also found is that there is pressure for companies to be moving away from using those resources. We all know that we can't be burning fossil fuels in the way that we have before. We all know, I think a lot of us know, that we should be reducing our use of animals. For numbers of reasons, and obviously if you're a vegan then you're completely opposed to it, and that in itself is an increasing number of the population. So I see this criticism of being, well, you are restricted from buying certain stocks as saying, well, what are your actual expectations for those stocks that you're restricting? Are we going to be burning more fossil fuel? Can we afford to? No. Are we going to be using more animals? Is the meat industry going to be larger and smaller or smaller? I can create or formulate investment theses around why the bets that we have within the Vegan Climate Index will actually perform. And we better hope that they do perform, because if you created a portfolio around all our exclusions and then said, this is the portfolio that's going to perform, you'd be looking at a pretty horrible world in 10 years' time. So that's my response, is that I fully expect and hope that there will be performance from ethical funds, because I don't want to live in a world where there isn't.
Sucheta?
Yeah, I call this the zombie myth, the myth that won't die. It appears that no matter how much data we have, how many research papers there are that show that you don't sacrifice performance when you invest responsibly, it's still one of the first things that we hear from people is, oh, well, you know, I'm prepared to give up performance in order to have a better world. But you really don't need to at all. And I think we now have a significant number of academic papers, as well as papers done by people within the financial industry. And we also have what are called meta-analyses, which are papers that analyze all the papers that are out there. And they are all basically showing that while you might not today, and I am agreeing with Claire that this might change in the years to come. So today you're not getting outperformance from investing responsibly, but you're not sacrificing anything. And with respect to real world examples, MSCI has an index called the ACWI, the All Country World Index. And over many years, leading right up to August 31st data, the ESG leaders ACWI has matched or just very, very slightly outperformed the non-ESG leaders, the traditional ACWI. And I think that just shows from a purely financial standpoint that you don't sacrifice returns at all to invest this way.
Great. Kelly, anything to add?
Yeah, I would just echo everything that Claire and Sucheta has said, that the studies are there, the proof is there. And to your point, Claire, about a world in which ethical portfolios, so-called ESG, truly ESG graded portfolios that are aimed at creating a better world, to the extent that they do perform, the world will be a more livable place. To the extent they don't perform, it will be less livable. It is that basic at this point. I think that the reality of climate change is making these decisions imperative. This is not, we want to feel good about what we do, though we may. It's we need to put these screens in place. We need to think about what these technologies are going to mean by 2050 is one standard, but there are even sooner than that. So I think that the more that climate change becomes a reality, the more that other environmental impacts, including those caused by factory farming, the more those become investment risks, the clearer and clearer the thesis that my co-panelists have put forth is going to bear out. So I encourage everyone again to educate themselves on what the risks look like. It can seem like a complex web, but once you begin to learn about what companies are doing, what the risks are, the information is out there and becomes more digestible. And again, I just encourage everyone to learn as much as possible.
Okay, great. So how do you guys think about establishing criteria for an ethically oriented investment portfolio? It seems that there are a wide range of possible answers, and theoretically, you could end up with a very small investment universe of opportunities to choose from. Is there any truth to that? Kelly, why don't we start with you? Oh, sorry. No, go ahead.
No, let's mix it up. Yeah, go back to Kelly.
Oh, well, thank you. Well, again, I'm sure my panelists will agree. There are multiple opportunities to invest. I don't think that you should again think that you're going to be limited. You can start with an ethical screen. I know we've talked about crueltyfreeinvesting.org, which does a good job of making very clear these companies exploit animals, these companies do not exploit animals. And according to their website, there are just over 1,489 companies that do, 4,511 that do not. So just beginning there, you can see there is a big universe to invest in, especially if you don't want to involve yourself in animal exploitation. So, but in terms of thinking about how to strategize, begin perhaps with your ethical screens and then move on to additional screens, to these ESG ratings that we're talking about. What aligns with your values? What aligns with your investment objectives? Some of this, each of us can do on her own. For other elements of it, then we'll want to look to financial advisors into their advice and their help and their help constructing portfolios. So that'd be my big picture response.
Thank you. Claire?
I can understand where you're coming from with this question, and It's something that I guess our index has also been charged with as being, oh, there's too much in technology or too much in financials, and the problem is, I mean, as far as our screens are concerned, there are just too many damaging industries, and we are removing companies with I suppose relatively small exposure to certain things. But then you remove a large company, and then that leaves you with fewer companies to invest in. If you take out, as we do, about 48% of the S&P 500, and then you're not keeping a large amount in cash, but you're investing the whole amount, then essentially everything else is grossed up as a result. And so, those kind of biases, I suppose, result from the screens that we've imposed. And it's simply a function of the fact that if you're looking at large cap, and everybody has the most money in the large cap because it's the largest liquidity, it's the largest companies, supposedly the safest companies as well. Certainly, the larger cap index will have a lower volatility than, say, mid cap or smaller cap indices. Then that's where people have the majority of the money, and that's where we started by providing a solution for that, because otherwise there really wasn't anything. And you just can't suddenly create vegan companies from nothing, and then they kind of pole vault into the S&P 500. So starting from that universe, your choices are more limited by virtue of the fact that these very large companies are doing damaging things, and certain sectors are completely verboten. Obviously, the energy sector just drops out completely. The majority of the food sector, consumer staples sector, drops out. Big pharmaceutical stocks drop out. So I think really it's about changing society if we can, and encouraging these companies to move in the right direction so that they become investable, because that's what we want. If you have an ethical standpoint, I think you have to invest according to that ethical standpoint. But fortunately, what we have seen is that the index has been, providing similar kind of risk to the market in terms of the volatility. It hasn't caused people to be, taking dramatically more risk than they need to because of the balance that we have within the portfolio. The portfolio construction rules we're applying, particularly to the largest stocks, so we're not grossing them up as much as we theoretically should if we were just operating on a market cap basis. And so with those kind of measures, I think you have enough there, and you can avoid excessive concentration.
Sucheta?
Yeah, I'd just like to add a little bit here about shareholder engagement, because I think this is also a very important point. And I think Claire was saying, we want to encourage companies to stop doing bad things so that we can invest in them. And so I think sometimes when you're looking at, for example, a fast food company, and you might say, well, you know what, I don't eat fast food and I don't really want to invest there. But if you can convince that fast food company to, for example, reduce the amount of antibiotic it accepts in its chickens or in its beef, then you're having actually you're having a huge impact on farming across the world. And so I think engaging with companies and talking to them about what is acceptable and how to do better is a way. So maybe that isn't a company that you like everything that they're doing now, but you're still going to own them because you're pushing them to do better. And one of the ways this is happening a lot now is antimicrobial resistance, AMR. So this is a very kind of one of the things that people, that investment managers are looking at with respect to meat is reducing the amount of antibiotic that's used in factory farming, which has huge impacts on the animals themselves, but as well on humans as we ingest that, on the water, pretty much everything. So I think these are key initiatives that if your investment manager is supporting those and talking to companies about them, then perhaps that makes it mitigates the effect of holding that company in your portfolio.
That makes sense. Actually, Leah Garces, the president of Mercy for Animals, mentions this a little bit in her work with Tyson Foods, because I guess they brought up animal welfare, and she got a lot of flack for it, for working alongside with them, etc. And she made the point that, look, like, you know, animal welfare standards will increase the price of chicken that they provide, and it also shines a light on what's going on with the treatment of these animals. And that's done more, she said, in that one instance, working with that company, than any amount of lobbying from, you know, a non-engaged collaborative relationship with them. So it makes perfect sense that there can be a big impact there. So moving forward then, let's talk about Beyond Meat for a moment. It was a huge IPO last year. Pretty much you have to be living under a rock not to have heard about it or seen it everywhere. And the vegan community was clamoring to own its stock. Its stock quickly increased 10 times its IPO price to the $230 range, and then came down significantly. It's now trading around $130 a share. Some people made a lot of money, some lost a lot of money. It might be a terrific company and align with one's ethical values, but when there's a limited supply of shares and a lot of public demand for these shares, the price to own that stock to get out of whack with the underlying value of the company. How should ethically minded investors think about these sorts of situations? Claire, you can kick us off here.
Okay. Well, I think it's about having a diversified portfolio. I think with Beyond Meat, it was obviously a very highly publicized IPO, and being the first, you know, company only producing vegan products to IPO on the stock exchange, that created so much of a hype around it that a lot of people who are private investors that maybe do not usually get involved in the stock market also got involved. And yeah, I would agree, they've certainly had a wild ride. I don't want to get into sort of forward expectations for the company or anything like that, but what I would say is that its volatility has definitely been increased by the initial buying, by a number, quite a lot of short activity which occurred in that period of time, which was really, really painful for the shorts because there was so little stock available, and it really aggressively caused that price to soar. When there was more stock that came onto the market, it sank back, and I think it went back to the 70s. And then it's kind of moved a little bit more stably, more in line with people's expectations. The problem we have is that combination of illiquidity, lack of stock to borrow as well in the initial phases, and then the sheer fact that it's extraordinarily difficult to value a company whose revenues are growing, that has never been profitable before, that is only just turning profitable now. You know, the valuation that you put on the company is a function of the future cash flows. And it's extremely difficult to put a number on what those future cash flows will be because of the newness of the product, because of the rapid growth of the company, the acceleration of demand, the international expansion. You know, so they have high revenues, they also have high costs to do with the expansion, to do with the marketing spend. You have issues of, you know, capacity in terms of production. So there's many variables that are much more volatile in themselves, as compared with, let's say, you know, a food company that's been around for the last 40, 50, 60 years on the stock market, where you know, the drivers of their returns, of their profits are very much well known. So I think that investing in these companies has to be done as part of a diversified portfolio. We are providing with the index a version of the stock market, a way of investing into the stock market, which is very much more balanced across industries than investing in just a few companies based on, you know, a certain ethical criteria. And so I think that the diversification is so important. Definitely go into these companies. If you see IPOs, they may be interesting to you. Maybe don't go in straight away. Let the stock settle. Sometimes things get very hyped up, then they pull back. This is totally normal. In fact, in my years of being in the financial markets, I've seen that happen many times. So I would just be a little bit more careful with those companies because of the very high volatility, which is a natural function of the fact that they are very new, high growth companies, and just put a small amount of your portfolio into them if you want to proactively bias your portfolio a little bit towards them. Don't go overboard though, because you will have a roller coaster ride.
Noted. Sucheta?
Yeah, I think that's actually very important, the fact that your portfolio is diversified. I think you really need to look at, what your portfolio is composed of, and also whether you have the personality to be comfortable with the level of risk as the volatility goes up and down. And this happens, not just with Beyond Meat, but I think Tesla is another perfect example of this kind of stock that people are saying, oh, I really want to own it, and then it's gone crazy, right? But I definitely, what I would echo is Claire's comment that if you want to own these stocks, it's probably safer for you to take a look at a mutual fund or an exchange traded fund that owns them, because then you've got an investment manager who is proactively managing that stock as part of usually a very responsible portfolio. And they will be able to manage that risk and volatility more effectively than you might be able to as an individual investor. So I think the demand for those stocks is really important, because we are showing the market that people want to invest this way. So I think that's really key, and you don't want to not buy it. You definitely want to show your interest, but doing it within a diversified mutual fund or exchange traded fund, I think probably makes sense for most investors.
Great, thanks. Kelly?
Yeah, again, I would echo everything my co-panelists have said, perhaps most loudly, that don't be afraid of these stocks, right? To your point, Sucheta, we want to show demand for the stocks. I know people want to participate in these exploding companies that are doing good things in our view, and some of our view anyway, for the environment, for people, for animals. It's exciting. We want to be involved. Of course, you need to mitigate your risks. I think it's a great suggestion. Get your exposure via an ETF, via a mutual fund, invest relatively small amounts, certainly get advice wherever possible, and have an advisor help you manage your risk. I think we're going to see another similar explosion with Oatly, which I think is the next expected IPO, or perhaps Just. I'm not sure what Just is going to look like. But to your point, Claire, about international expansion, they need a lot of money to do a lot of big things, but suddenly they're big players on stages. They get a lot of press. So I think that volatility is going to be inevitable. Exciting, again, from our perspective of seeing these companies just come onto the market and have a massive impact. So I guess for your viewers, again, if you're looking at the next IPO, thinking about this, perhaps watch what Oatly's doing, see what it projects to do in the next few years. If you think you may be interested in participating in that stock and buying it once it IPOs, and think about how you might expose yourself and how you might get good advice on how to manage the volatility and your risk. But don't shy away. Come participate in it.
Well, on that note, there's a great follow-up question I have for you guys then, because Oatly has been in the news a lot recently, and not just because it's set to go public, but in the way it's set to. They took, funding from Blackstone, I believe, and I confuse that sometimes with BlackRock, so thank you, Kelly, for pointing that out. But that's been a constant and frequent point of division amongst vegans and ethical investors alike around whether or not to perhaps boycott companies, because a lot of people are calling for boycott on Oatly based on the fact that they took investment from Blackstone, who's aligned with Donald Trump, for example, many claim, and perhaps not nearly as aligned with the values and vision that Oatly has for itself. What would you guys have to say about that? I guess everybody's quiet because now I haven't called on anybody. So Claire, how about we start with you again?
Okay. I think companies do need to consider who they take money from, to the extent that they have any power over that. And I do think that Oatly probably did. Obviously, once a company gets onto the exchange, they have no idea who is buying their shares. It could be, investors who are very aligned. It could be activist investors who have, have ideas about how the company could be changed. But Oatly obviously is, something of a star player in this area of plant milk. Along with a number of other companies in this space. They're doing kind of pre-IPO financing, in the kind of hundreds of millions, in the same way as Beyond Meat did before it IPO'd. And I think, given the way that Beyond Meat obviously did very well, I think that they probably could have been quite courted. I think there was probably quite a lot of demand for that round. I'd be super surprised if they struggled to fill it up. There are some large players in the private equity space, that would have been interested, that maybe did not get into that round. There are end investors as well that will look at larger private equity deals like that. And I do think it is important for companies to do due diligence and to continue that, to consider that kind of reputational risk. I've seen hedge funds brought down by having the wrong kind of investors, because the investors that they brought in initially maybe pulled out their money as soon as something looked a little bit looked as if it was maybe going wrong, and brought down the hedge fund. So I've been very conscious about this always in my investment career, and it is something that companies should certainly consider, if they have that power, to be a little bit more selective about their investors. Even a company as large as Oatly, it's certainly something that some of the investors in the startup and early stage growth are super careful as to who they have coming into their rounds. They're concerned about certain VCs, they're concerned about certain strategic investors. I think it was a bit of a slip up by Oatly to do this.
Kelly?
Sure, so that's really a very interesting point, that we don't know what Blackstone's intentions are. I think that's a great call out, Claire. And so certainly it would be important for these companies to consider whom they're having invest in their companies, of course. I would say, just to abstract from this a little bit, I think it's a good problem for the vegan community to have. So if we can just stay there for a moment. These are massive corporations interested in getting into this space. Whether they're doing it with not so great motives, I can't say, but just that there's this level of interest from these major players, I think is a good sign, a heartening sign. So I'm glad that there is that interest. Oatly did respond to this. I think they did a pretty good job of justifying why that they accepted Blackstone's investment. Whether that argument's a good one or not, will be a long-term matter of debate for the community, and that Oatly will continue to communicate about, I'm sure. But to the extent that Blackstone's intentions are not bad, that they're looking to maximize their investment in the company and see it succeed, and that Blackstone's interest sparks other big players' interest, the Apollos, the Carlyles. You see the space beginning to become more invested in these transformative technologies. I think that will be a good thing. I also don't think it would be a bad thing if this conversation were reversed, and it were big food companies saying to Blackstone, we're not going to accept your investment if you're in the plant-based, alt protein, cultivated protein space. So in my long-term dream, I'm thinking, well, then that would be a good thing if this conversation were happening among the companies that are doing so much damage to the planet.
Interesting. Sucheta?
I think most of all the important points have been made, so I don't have a lot to add. But I definitely feel, I guess, on the one hand, that almost everybody who's got a lot of capital and something to provide who could have helped Oatly has some drawbacks that you could have found. But I also think it's very positive, the whole discussion and or outcry or whatever this issue, because it is raising the fact that we want to change the entire financial system. So it's not just the Oatlys and the Beyond Meats that we want. We want to go up a tier and say, well, the companies that are financing them, we would also like them to look more at environmental, social, and governance issues and say, are they companies that we want to be dealing with? And so to the extent that that tier above the company itself that's IPOing is starting to look at its own behavior and its own holdings, I think this is a positive discussion to have.
Yes, I'm just thinking about it from the perspective of the PR that has happened, the press attention that's happened to this. I would hope that possibly within Blackstone, that gives them pause in terms of them considering the investments that they are making, that they may well, as a function of one investment that they're making in a damaging industry, a mine or whatever, that they may be excluded from a deal. Because people don't want to have this this bad press, and that definitely would be a good thing.
So the attention is helpful is one of the key takeaways here. So and to your point, there's now about transforming the food system, Sucheta. That might lead us well into the next question, which is like around for transforming the food system. What sort of balance do we need to see, if we even know, between divestment from factory farming and investment in alternatives and impact investing? Kelly, maybe we can start with you on this one.
Sure, thank you. So from Pivot's perspective, we need as much divestment as possible from animal agriculture and as much investment as possible into plant-based alternative proteins, cultivated proteins, non-animal-based alternatives. So that we are firmly rooted there. From our perspective, divestment can obviously weaken large food companies' financial positions, their access to credit, their ability to expand, their ability to continue operating the way they are. But more broadly, divestment can call attention to the various risks, not only to investors, but also to all stakeholders, to all citizens, to all people living on the planet, can bring attention to the various risks involved in factory farming. And that's what we're really looking to do, to both diminish large food companies' financial power and also educate the broader public about the risks involved so that they can become more involved, so that they can understand, wait, I don't want my university's endowment to be involved in factory farming. Look at what it does to people, look at what it does to animals, look at what it does to the planet, look what it does to the potential for long-term returns. These companies are not sustainable. I don't want my college, and I'm investing in my education, I don't want my college to be invested in companies that are not only doing damage, but are unlikely to perform over the long term because their practices are not sustainable. They're not physically sustainable, they're not financially sustainable. So I'm speaking about divestment, but I'm just trying to educate your listeners about why divestment is important. It's not just about what it can do to companies, it's about how it can inform everyone, every stakeholder who can get involved, whether they're investors or not. And here, I want to make clear, because this conversation is about investment, but there's so much that people who aren't in the markets can do to become involved in transforming the food system, particularly on the divestment side. I've referred to students who can influence their endowments, employees who can influence their employers, their pensions, the financial managers who are looking at their pension funds, who need to be more responsible, who are hearing from their stakeholders that they need to look at this industry. And preferably, from the stakeholders' perspective, if the stakeholder is saying this, divest from the industry. And the more conversation we have about this, the more attention we can draw to it, then the more people are going to understand this industry. It's not just fossil fuels. There are other industries that are very damaging, that are damaging to investors, that are damaging to the environment, that are damaging to people, that people can become empowered to invest in various ways in the world that they want to see. So on the other hand, of course, we need investment in alternatives because we are a growing population. We do need to feed ourselves, 10 billion people by 2050. And as we get there, it's not going to be enough, in our view, for plant-based and non-animal-based to rise X, while animal-based rises Y. So this is also part of the reason that we're focused on moving money out of traditional animal ag and into sustainable, healthier for everyone alternatives, healthier also for investors.
Claire?
I was wondering if Sucheta wanted to say something, because I just seem to be jumping in all over the place.
Well, we're happy to hear from you, Claire. But yeah, I think that definitely we are all in the market. So maybe you're not in the market individually, but I definitely agree with Kelly's point that in Canada you have, maybe it's your union, maybe it's your school, certainly it's the Canada Pension Plan. So getting involved in the divestment movement and targeting any of those areas, I think is something that everybody can do, whether or not they have an individual portfolio. I think that in the end, one of the analogies that I've heard that I like to use is we're all aiming to get to the same place, and we are maybe taking different paths to get there. So divestment is one path, and certainly investment in alternatives is another path. And then trying to kickstart research into alternatives is also something that perhaps some people would be able to do that not everybody can do. So I think whatever it is you're doing, whether you're using your investment dollar, whether you're using your power as part of a group, whether you're using your consumer dollar, it's just important that you do something. So I would say that within this, whether that's on the divestment side or on the encouraging investment side, you just want to get involved.
I think that it's beholden to a lot of to as many people who can to divest. Why? Because there's a very, very large amount of money which is run to passive strategies on market benchmarks. An increasing amount, in actual fact, in the last sort of 10, 15 years, more money has gone to passive strategies than it's gone away from active. So this is creating an issue in terms of price discovery, because passive funds do not trade. They basically only trade when things come out of the index. So I think it's beholden to anybody who can choose their portfolio to come out of these stocks. And my hope is that we will see these stocks fall out of the benchmark indices. There's some 10 trillion of assets that are tracking the S&P 500 that are owning a number of, large meat companies, etc. Because they say they have to, because that's what their mandate is, and they can't deviate from their mandate. If we can find some way to push these stocks out of the S&P 500, that's $10 trillion worth of money that will drop these stocks like a stone, because they don't have to own them anymore. So that's my goal.
Yeah, and I would just chip in that definitely has happened on the fossil fuel side. So this isn't a sort of pie in the sky, maybe this would happen. We have seen this happen in the past couple of years with fossil fuel companies. So it's definitely, it's something we could do.
Mm-hmm. This is a bit of a theme now that we're hearing, and it's not just in this panel, but between what you guys are saying, but the maybe underappreciated or underfocused power that the individual has in terms of doing their investigation, asking hard questions, or even curious ones. It's something I actually tell people to do when it comes to policy around diet. A lot of life insurance companies now are starting to investigate what Medicare has done with the Dean Ornish program, which is to start offering lower premiums to people who are following low-fat, whole food, plant-based diets. And I always encourage people to just ask their own insurance provider, why aren't you doing this? So on that note, what are some good ways for individuals to vote with their dollars from an investment perspective? What are the sort of thought processes or options out there to make an impact with our investment dollars? And perhaps even what might be a good investment idea for vegans right now? We can start with you, Sucheta.
So I think for everybody out there who is in Canada, the Responsible Investment Association is Canada's umbrella organization for responsible investment. They have something called the RI Marketplace, which does cover broadly all responsible investments, but it's a good starting point. And then you can take a look at what's available there. And then you have to dig a little bit deeper and say, okay, how many of these are focused on what I'm particularly interested in, whether that's some combination probably of fossil fuel divestment, animal rights, humane treatment of animals, antimicrobial resistance, not testing on animals. So then you have to do a little work. And sometimes with products like exchange traded funds and mutual funds, looking at the prospectus, you don't have to read the whole thing. I know they're really big, but just going to those specific pages around exclusions and what they're investing in will help. There are also, there's a list of responsible investment advisors on the RI website as well. And I think probably everybody on that list would be happy to have a 20-minute phone call with you if you get overwhelmed by the choices that are on there, and kind of talk you through which ones are focusing on plant-based proteins and animal rights, factory farming, cruelty-free investing.
Great, thanks. Claire?
Obviously, I'm going to say that there was an ETF that was launched last year, which was, I guess, tailored to the concerns of vegans and environmentalists, and we'd very much appreciate anybody looking at it from the perspective of investment, and we do believe that it addresses these concerns in a way that no other ETF that we're aware of addresses them. But it's not only for vegans, it also has, it also has a lot of power in terms of its approach in terms of any kind of environmental damage, mostly because of the way that animal agriculture is hurting us in terms of water usage and in terms of waste products. And obviously the additional greenhouse gases that you can get out of your portfolio over and above by excluding animal agriculture, over and above simply going fossil fuel free. So that's my little promotional aspect there. I think other than that, using certain other types of platforms, I think As You Sow is also very good at investigating the holdings of other funds, and they are ranking our VEGN as well. But you can certainly look at other funds there. And I'm also aware of some new products that are coming out in terms of apps that are including these kind of criteria, particularly around ESG, that may be helpful to people if they want to put together some of their own portfolios and investigate individual stocks. Because in actual fact, I mean, ESG data is fairly hard to come by and can be quite expensive, and is mainly bought by the asset managers. It's has been hitherto less available to individuals, but that's something that is starting to change. I'd like to encourage people also to join a platform which I've created, which is called Beyond Animal, and our intent with that platform is to bring some non-listed equity, some private equity, venture capital deals to investors, obviously, with the appropriate safeguards in place in terms of the the financial status of those investors, the country, according to obviously the regulatory guidelines that or rules that are in place in each country. We have an ethical investor survey on that platform that people can complete that already will tell us the kind of things that people are interested in, so we know where to go, so we can orient ourselves towards the kind of deals that people are looking for. So that's a few ideas on my side that we we would certainly appreciate and that are actionable now.
Great, thanks. Kelly?
Yeah, thank you. And Claire, the Beyond Animal platform is fantastic. I use it myself. There are so many resources there. Thank you for creating it. Thank you for everything you do. In terms of opportunities, obviously the vegan ETF, and you can invest in Beyond Meat, but there's so much more that people can do outside of the market. And I think I want to call attention to this again, that if you're investing in transforming the food system, you can think about your investment in different ways. So yes, when you have money available, there will be opportunities and increasing opportunities. I think we can all agree to invest in this space. But until that time, you can invest your time, your most valuable asset. You can support organizations with your time. And I've done this for a number of organizations, and it's actually how I've ended up here. You can spend your time educating yourself. You can make small donations. Even the smallest ones count, to organizations like GFI, the Good Food Institute, that's behind a lot of these big launches. They do a tremendous amount of research. They also connect companies with investors. They are helping make these things happen. They were a very significant influencer in Beyond Meat. So if you don't have a lot, just being invested in that way, in the movement, in Pivot, please look at what we're doing. Again, we're building our resource library so that you can become more aware of the various risks and how to navigate them and how to make investment decisions when the time comes for you to make investment decisions if it hasn't already. So again, I just want to call out that larger notion of investment, and we're all stakeholders in this. We are all invested in transforming the food system and transforming industries more generally. Environmentally damaging industries and another way damaging industries. So get involved. Everything's a good investment. Get involved.
I love it. Actually, and for GFI's perspective, we didn't have Bruce or anybody from there participate this year in speaking, but there is a panel that does cover a lot of interesting and engaging content on the future of lab-grown meat and cellular agriculture. I encourage people to check that panel out, and it features our own Nathaniel Erskine-Smith and Isha Datar and some others. And it's moderated by Liz Marshall, who directed the film Meet the Future. And to your guys' points, like this is an area where, individually we all take notice too at possibilities and alternatives that are coming down the pipeline. We can be poised for an even more exciting future. So I really appreciate the time you guys have taken today. I know for most people who might be in my shoes, who don't know the first thing about what to think about when it comes to ethical investing, this has been highly informative. I wanted to, just before I let you guys go, I just wanted to see what your preferred points of contact are online. Where can people find you? Sorry, Claire, we can start with you.
Oh, okay. Well, we have our beyondinvesting.com site, which is the advisor site, and where you can find information about our general approach and the index that's underlying the ETF. And then the vegan ETF .com is the site for the vegan climate ETF, which we launched with all the sort of official information about that product. And the site that I mentioned before that has the ethical investor survey is called beyondanimal.com, and that's actually a connection site where you register, create your profile, and can connect with other people who are, as we say, accelerating the growth in the vegan economy, which is what we're trying to do. A vegan economy being an economy where no animal is ever exploited again. Isn't that a nice dream? And basically, that's something you can join, and there's a lot of resources, as Kelly mentioned, and there will be in the future access to some of these investment opportunities in the new food space.
Great, Sucheta.
So as I mentioned before, I am on the Responsible Investment Association website. So if you go to the RIA website, there will be a Find an Advisor, which then asks you what province you're in and some information. And so I'm on there with a bio and some contact information. That's the best way to reach me.
Great, thanks. And finally, Kelly.
Yeah, so I encourage everyone to check out pivotfood.org. There we are building up our resource library, also a company's database that includes food companies, think tanks, and and capital, including beyond investing there. So that's a great resource for everyone. You can also reach me at kelly@pivotfood.org, and I'll be happy to direct you and answer any questions you might have.
Fantastic. Well, once again, I thank you guys for taking time out of your schedules to help inform and educate the rest of us. And thank you for all the work you're doing. And hopefully when, we're all allowed to, do these things in person, we'll be able to have you guys at a future Veg Fest in the flesh.
I'd love to do that. Thank you so much.
I'd love to do that too. Thank you.
All right, great. Thanks a lot, guys.